you, John. Now let's hear from Lorna Whiteaker more about choosing what structure is right for your business. Lorna?
Oh, thank you, Debbie and John. So we're going to talk about corporations. The corporation is an artificial entity that is created when documents are filed with the Secretary of State for your particular state or the state in which you want to file your corporation. Once formed, the law treats the corporation as separate from its owners in several aspects. Corporations are more complex than other business structures because they tend to have costly administrative fees, complex tax and legal requirements. Because of these issues, corporations are generally suggested to be established for larger companies with multiple employees or higher revenues. For businesses in that position, corporations offer the ability to sell ownership shares in the business through stock offerings. Back to what John was saying, that some people really prefer to have that stock certificate. Going public through initial public offering, IPO, is a major selling point in attracting investment capital and a high quality of employees. In forming a corporation, the corporation is developed under the laws of the state in which it is registered. To form a corporation, you'll need to establish your business name and register your legal name with your state government. If you choose to operate under a name different than the officially registered name, you'll most likely have to file a fictitious name, again, that assumed name, trade name, or a DBA, doing business as. State laws vary, but generally corporations must include a corporate designation, corporation, incorporated, limited, at the end of their business name. To register your business as a corporation, you need to file certain documents, typically articles of incorporation, with your state's Secretary of State office. Some states require corporations to establish directors and issue stock certificates to initial shareholders in the registration process. Here again, you must contact your state business entity registration office to find out about the specific filing requirements in the state where you formed your business. If you are hiring employees, read more about federal and state regulations for employers. Corporations have very specific tax implications. Corporations are required to pay federal, state, and in some cases, local taxes. Most businesses must register with the IRS and the state and local revenue agencies and receive a tax ID permit or number. When you form a corporation, you create a separate tax-paying entity. Regular corporations are called C corporations because they're prepared under Subchapter C of Chapter 1 of the Internal Revenue Code. And this is where you will find where the general tax rules affecting corporations and their shareholders are. So you can look that up yourself. Unlike sole proprietorships and partnerships, corporations pay income tax on their profits. In some cases, corporations are taxed twice. First, when the company makes a profit, and again when dividends are paid to the shareholders on their personal tax returns. Shareholders who are also employees pay income tax on their wages. The corporation and the employee each pay 1/2 of the Social Security and Medicare taxes, but this is usually a deductible business expense. Now, corporations have some advantages. So, a limited liability. When it comes to taking responsibility for business debts and actions of a corporation, shareholders' personal assets are protected. Shareholders can generally only be held accountable for their investment in the stock of the company. Now, there's an ability to generate capital for corporations because they have an advantage when it comes to raising this capital through the sale of the stock. Corporate tax treatments they're separate from their owners. Owners of a corporation only pay taxes on corporate profits paid to them in the form of salaries, bonuses, and dividends, while any additional profits are awarded a corporate tax rate. which is usually lower than the personal income tax rate. Corporations are generally able to attract and hire high-quality and motivated employees because they can offer competitive benefits, and there's a potential for partial ownership through stock options. The disadvantages to a corporation come in the form of time and money. Corporations are costly and time-consuming ventures to start and to operate. There are compliance issues. Incorporating requires startup, operating, and tax costs that most other structures don't require. Double taxing. In some cases, corporations are taxed twice. Again, first, when the company makes a profit, and again, when the dividends are paid to the shareholders. And corporations are highly regulated by federal, state, and in some cases, local agencies. There are increased paperwork and record-keeping burdens associated with this entity. And compliance becomes very important. Now, then we have partnerships. So a partnership is a single business where two or more people share the ownership. Each partner contributes to all aspects of the business, including money, property, labor, or skill, and in return, each partner shares in the profits and losses of the business. Because partnerships entail more than one person in the decision-making process, it's important to discuss a wide variety of issues up front and develop a legal partnership agreement. This agreement should document how future business decisions will be made, including how the partners will divide the profits, resolve disputes, change ownership, such as in bringing in new partners or buying out of current partners, and how to dissolve the partnership. Although the partnership agreements are not legally required, they are strongly recommended, and it is considered extremely risky to operate without one. There are three types of partnership arrangements. There's a general partnership, which assumes that the profits, the liability, the management duties are all going to be divided equally among the partners. If you opt for an unequal distribution, the percentages assigned to each partner must be documented in the partnership agreement. Again, something in writing. Limited partnerships, also known as a partnership with limited liability, are more complex than general partnerships. Limited partnerships allow partners to have limited liability as well as limited input with management decisions. These limits depend on the extent of each partner's investment percentage. Limited partnerships are attractive to investors for short-term projects. Again, everything should be in writing. Joint ventures act as a general partnership, but usually only for a limited period of time or for a single project. Partners in a joint venture can be recognized as an ongoing partnership if they continue the venture, but they must file as such. Partnership liability and risk. Owners of a general partnership have unlimited personal liability. In general, each partner is jointly liable for the partnership's obligations. Joint liability means that each partner can be individually held responsible for the entire amount of an obligation of the partnership. However, as a sole proprietorship, insurance and quality contract design can protect the partnership against most risks. Management. Partners have equal management rights unless otherwise stipulated in the partnership agreement. Again, something in writing. A partnership exists as long as specified in the partnership agreement. The partnership agreement will determine the consequences of a partner dying or leaving the business. The business could remain in the hands of the remaining partners or be dissolved. Again, partnerships are similar to sole proprietorships in their legal creation and maintenance, and thus have a low expense and legal formality. New potential partners should create their partnership agreement with the help of an experienced attorney or an accountant. Partnership agreements cover topics such as capital contributions, distribution of profits, management duties, bookkeeping, banking, and termination. Partnership taxation. Most businesses will need to register with the IRS, register with their state and local revenue agencies if appropriate, and they will need to obtain tax ID numbers or permits. A partnership must file an annual information return to report the income, deductions, gains, and losses from the business's operations. But the business itself does not pay the income tax. Instead, the business passes through any profits or losses to its partners. Partners include their respective share of the partnership's income or loss on their personal tax returns. A partnership tax return generally includes annual return of income or loss, employment taxes, and excise taxes. Partners in the partnership are responsible for several additional taxes: their personal income tax, self-employment tax, and making their estimated tax payments. Partnerships must furnish copies of their Schedule K-1, that's Form 1065, to all partners by the date Form 1065 is required to be filed, including extensions. Partners are not employees and should not be issued a Form W-2. The IRS Guide to Partnership provides all of the relevant tax forms and additional information regarding their purpose and use. And you can certainly go to a tax professional or CPA to get all the things you need to know about this and get guidance on that. Advantages of a partnership. Well, they're fairly easy to do and inexpensive. They are easily formed, and the majority of the time spent starting a partnership often focuses on developing the partnership agreement. In a partnership, each partner is equally invested in the success of the business. Partnerships have the advantage of pooling their resources to obtain capital. This could be beneficial in terms of securing credit or by simply doubling your seed money. Partners bring complementary skills. A good partnership should reap the benefits of being able to utilize the strengths, resources, and expertise of each partner. Partnerships have an employment advantage over other entities in that they can actually offer to their employees the opportunity to become a partner. Partnership incentives can often attract highly motivated and qualified employees. Of course, partnerships have some disadvantages as well. One of the biggest is the joint and individual liability. Similar to sole proprietorships, partnerships retain full shared liability among the owners. Partners are not only liable for their own actions, but they are also for the business debt and decisions made by the other partners. In addition, the personal assets of all partners can be used to satisfy the partnership debt. Disagreements between the partners, actually very common. With multiple partners, there are bound to be disagreements. Partners should consult each other on all decisions, make compromises, and resolve disputes as amicably as possible. And if you have your partnership agreement in writing, that's going to make this very much easier. Shared profits, because partners are jointly owned, each partner must share the successes and profits of their business with the other partners. An unequal contribution of time, effort, or resources can cause discord among the partners. Now, Debbie, do we have any questions so far?
Actually, we do, Lorna. It goes to the partnership question. Can a married couple set up a sole proprietorship, or does that have to be a partnership or one of the other forms?
They can be a sole proprietorship. Very common.
They can be a sole.
Yes, they do not need a formal partnership agreement. Sole proprietorship works just fine for a married couple, and they can also be a corporation.
I'm sorry, I didn't mean to interrupt you.
That's right. They can also be a corporation. A business structure is decided on what is best for the organization. Whatever the business is best decides what the business structure should be.
Okay.